If you trade funded accounts, you need to know what risk strategy to use. It's different for everyone. It's not one size fits all. It totally depends on your trading strategy, but also your risk appetite. You need to first take into account what risk to reward you use and your win rate. If you have a high risk to reward, then you might need to risk a lot less. You can get away with risking 1%, half a percent, because a single trade, if you do something like 5 risk to reward, then one trade will make you 2.5%. For me, it's accuracy based trading with not a huge risk to reward. So I usually have around an 80% win rate, and I aim for around 1 to 1.5 risk to reward, where I cash most of my position. Towards the end of the video, I will show you a way where you can make more from the trades that you are currently taking, but it's very important that you understand why you're risking the amount that you're risking. It's also very important to understand that funded accounts don't mean shit. A lot of traders put funded accounts on a pedestal. They look at all that money and they think it means something when it doesn't. It's all B-book trading. The firms are paying you out from other people's failed challenges. Let's assume that 100 people attempt a 100k FTMO account. It costs £450 for 100k, and let's say 95% of people fail that challenge. It's probably going to be a bit more, but the prop firm has already made over £42,000. Now, out of the 5 people that do pass, some might not make it to payout, some might get a few payouts and then blow their accounts. It will be nowhere near the 42k net profit that the firm has made, so they are incentivized for your failure. That's why they used to have a time limit, but because of competition, even FTMO have already removed that. And just while we're on the topic, if you are deciding on what firm to use, always go with FTMO if your country allows it, because it's the most regulated firm. Even though FTMO can go out of business, a lot of these other firms are very shady. You'd rather go with the best bet. You need to be hard to kill. It's the same as having a bunch of bank accounts. You can't put all your eggs in one basket. So I'll jump into the risk that I use, and for stage 1, it's usually 2.5%. I will be doing a public funded account where I share all the trades, I share the recaps, and I'll take you through the whole process. And the whole point of that is to show you that less is more. I won't be taking many trades, but the trades that I do take will have a high chance of winning. For me, for funded accounts, stage 1 is about getting it out of the way. Stage 2 is about preservation, and once you pass, you dial the risk down even more. They are a great tool to grow your live accounts, but they do have these rules where they want you to fail on purpose, because their business is built on your failure. And the trades that I do take, for me, all my trades are categorized in terms of quality. It's A, B, C, and then there's also subcategories such as A+, A-, B+, and B-. And for funded accounts, it's always B+ or above. So it could be an A- trade, or even an A or an A+. The reason I'm doing this is if you take 2 losses in a day, it still doesn't breach your daily drawdown limit, because even if you risk 2%, because of spreads and slippage, you might end up losing 2.2, 2.3%. And usually I do leave runners, but I get roughly a 1.5 to sometimes 2 risk to reward from my trades. Some people who think that, oh my god, it's a 100k funded account, remember, it's a demo account, and treat it like a game, because it is. It's simulated trading. And if you treat it like a game, if when you buy the funded account, you already assume that you've lost that money, it's kind of like negative visualizations. If you set expectations and you think, oh, if I only make 5% in a 200k, that's 10 grand a month, then that expectation is what will set you up for failure. And those people that do risk less and they trade very cautiously, their equity curve is usually like this. They're taking a bunch of trades and the equity curve is going up and down. When it goes below 0, now they're a lot more susceptible to doing dumb shit, and when it comes near to 10, then they're more likely to rush it and take more risk to try get to that 10%, which usually backfires, pushes them back towards 0, and then they start doing more dumb shit, which ends up losing. For me, it's waiting for the best possible setups, and I'm happy to not take a trade for a week, for 2 weeks, because now they don't even have the time limits on them. Less is actually more, and that's one of the reasons why I'll be sharing a public funded account, is to show you that less is more. If I can outperform you and I'm barely taking any trades, and you have been trading a lot more proactively, you've been taking a bunch more trades, you've spent a lot more screen time, and you can't outperform the safe funded approach, then you need to just pick the best trades. The best way to improve your win rate is to simply eliminate the losses, to stop taking losses. It's as simple as that. But let's say I take a trade and I risk 2%. I will get something around 3, maybe even 2%, maybe 1.5%, depending on the actual trade. But if you do make 3%, you're already a third of the way there. And if in a day you come across another trading opportunity which fits your plan, now you need to understand that you have a total of roughly 7.5% daily drawdown limit, because it just gets added to your overall daily drawdown limit. So then I am more likely to risk a bit more because I'm playing around with profits. You need to keep in mind the psychology as well. It's not all about the money, it's about your psychology. If you're playing around with profits, it's a lot easier than if you are in drawdown. So the whole goal is to get into profits and then play around with those profits, but not do dumb shit. Just because you're in profits, it doesn't mean you start risking it on stupid shit. But if from one trade you're already a third of the way there and the second trade works, you've got a very big safety net to blow the account. So it's all about taking your time. It is simply mind games. It's all a game, so you need to treat it like a game without getting emotionally involved. And before you even jump into it, are you even profitable? Do you have a plan laid out? It's more than just knowing how much you're going to risk. It's knowing what type of trades you're going to take and how you're going to execute on those trades. Are you going to cash at a 1-to-1, or are you going to leave a runner? In what scenarios are you going to leave a runner? You have to predefine all your variables and stick to them, and as long as your trading isn't dog shit, then you will pass these accounts. People really think they mean something when a lot of these people online, if they're going with dodgy firms, if you see someone who's passing loads of funded accounts with dodgy firms, the likelihood is that they have partnered with that firm to use the fake payouts as promotion to then get people to sign up using their link. It's a very dodgy industry. Don't be finessed by all these fake influencers, because you do see them a lot and the trading space is filled with them. But if you do win a single trade and the second trade ends up being a loss, it doesn't mean you change your fucking plan. You trade the exact same. For me, it is risking more, because then your equity curve will look something like this, but only a few wins will end up making you pass. And if you are waiting for the best possible trades, you only realistically need a few trades. Now with this public funded account, I might pass it within a month. I might pass it under 2 months. It totally depends on what the market offers and if I'm able to capitalize on it. The difference between someone who's profitable and someone who's not, it's not that the profitable trader doesn't get annoyed, it's that he or she doesn't react when they are annoyed. They know when to step back and they execute to their plan regardless of how they feel. Now I'll show you some live market examples on how to capitalize more on certain trades, and a good example would be GJ a couple of weeks ago. This was an A+ on my setup. For the day we were up 300 pips, for the week we were up 550 pips, and it was coming towards end of session. It was a yen driven move, and you also had UJ on a level plus a trend line, and also EJ on the 61 fib plus key level, which was which was this over here. And that is an A+ on my setup. If you risk 2%, let's say, and you cash at the 1-to-1 and you leave a 10% runner. So this is how you make more from the trades. If you know a trade has high odds of longevity, meaning a longer term reversal, you leave a runner, because if you leave a 10% runner or even a 20% runner on this position size, if you risk 2%, that means you cash 1.6 and you leave 0.4% of the profits on the table. If price continues to push higher, then overall you'll only end up making 1.2%. But if it does go in your favor, which it did in this case, when it does come up and it offers you a potential counter, so there was this 61 which was pretty aggressive, but also this 50 and 61 of this move, break retest. You had Nikkei on level, which is the yen stock market, and also the yen index, which was on a 38 break retest. Now the trade is up 200 pips and the initial drawdown that you give it is around 50 pips. So what that means is if you left 20% on the table and it's up 200 pips, you can risk 0.8% completely risk free, risking the profits of this trade to add to that position, because if this level is breached and price continues to push higher, this runner is going to get stopped out anyways. And if that did go in your favor, even if you cash at a 1-to-1, you've still made 0.8% and this runner is still running, and you can use this runner to buy this low. where you can risk the profits of that runner on this low, and even if it breaches, then you can take this as a completely separate trade setup. When it comes to should you use a swing or the other one where it's like 1 to 100, I would always go with swing because I am taking a few trades and I don't use all of the leverage. So on the flip side, I can hold trades over the weekend, overnight, and through news as well, which I don't really. But the last thing you'd want to do is close a trade overnight and then it makes a move. One thing to also keep in mind is spreads and slippage. Wednesdays, especially if you have a sell, then the spreads are likely to be a bit higher. When it comes to the switchover at around 10 p.m, when spreads do go high, then either offload some of your position if it's near entry, or remove your stop loss if it's stop loss to entry, to avoid being wicked out. The rules are against you because they are set up to make you fail. The main thing that you should take away from this is have a solid fucking plan. Know what risk you're going to use and why you're using that risk. It's never one size fits all. Even in terms of strategy, if you trade the same strategy as someone else, you will always trade differently because there's a million ways to do it. You have to find what works for you. And the only way you do that is if you understand the logic behind all your decisions. So have your plan written out, the risk that you're going to use, the amount of trades, the currency pairs that you're going to trade, and also your management, how you're going to manage your trades. Once you have everything laid out, and as long as you follow logic, as long as you don't rush it, you will pass funded accounts. It really is as simple as that. There is no holy grail. If you watch this video to look for a holy grail, there isn't. It's as simple as take your fucking time.